Hello everyone and welcome back to Wealth Wizard. In today's video, we'll be diving into an important topic, Warren Buffett's warning about the dangers of speculative investments. Warren Buffett, often regarded as one of the greatest investors of all time, has provided valuable insights into the world of investing. His warning carries significant weight due to his remarkable success and track record in the investment industry. It is essential for us as investors to pay attention to Buffett's advice, especially when it comes to speculative investments. Understanding Warren Buffett's perspective. Warren Buffett's investment philosophy is centered around long-term value investing. He believes in investing in companies that have solid fundamentals, sustainable competitive advantages, and long-term growth potential. Buffett has expressed concerns and criticisms about speculative investments, which are characterized by their high volatility, lack of underlying value, and unpredictability. One area of concern for Buffett is cryptocurrencies. He has been skeptical about their long-term prospects, highlighting the speculative nature and the absence of intrinsic value. Buffett emphasizes the importance of investing in assets that generate cash flow and have tangible value. He believes that investing in speculative assets, such as cryptocurrencies, carries significant risks and lacks the stability and underlying fundamentals he looks for in investments. In addition to cryptocurrencies, Buffett has expressed caution regarding meme stocks. These stocks often experience significant price fluctuations driven by social media trends and speculation rather than underlying business fundamentals. Buffett warns that investing in meme stocks can be dangerous as they may not reflect the true value of the underlying businesses. He advises investors to focus on understanding the fundamentals of companies rather than getting caught up in short-term market hype. Buffett's caution against speculative investments is rooted in his belief that investing should be based on sound analysis, research, and a focus on long-term value. He advocates for investing in businesses that have a sustainable competitive advantage, strong management teams, and a history of generating consistent profits. Buffett's approach emphasizes the importance of investing in assets with underlying value and long-term growth potential rather than engaging in speculative bets that can be unpredictable and risky. Understanding Warren Buffett's perspective on speculative investments is crucial as it provides valuable insights into the potential risks associated with these types of investments. By aligning our investment strategies with Buffett's principles, we can safeguard our portfolios and make informed decisions based on solid fundamentals and long-term value. The risks of speculative investments. Speculative investments come with inherent risks that investors must be aware of. One of the primary risks associated with speculative investments is their unpredictable nature. These assets, such as cryptocurrencies, meme stocks, or highly volatile assets, often experience extreme price swings that can be challenging to predict or explain. This unpredictability makes it difficult for investors to make informed decisions based on fundamental analysis or long-term value. Another significant risk of speculative investments is the lack of underlying value and fundamentals. Unlike traditional investments, which are typically backed by tangible assets or generate cash flows, many speculative assets lack these fundamental aspects. For example, cryptocurrencies derive their value mainly from market sentiment and demand rather than any intrinsic value tied to underlying assets or cash flows. This lack of underlying value makes speculative investments more vulnerable to rapid price fluctuations and market manipulations. Moreover, speculative investments have a substantial impact on individual investors who are attracted to the allure of quick profits. The promise of massive returns in a short period can be tempting, leading investors to allocate a significant portion of their portfolios to speculative assets. However, this exposure to a high level of risk can result in substantial losses if the speculative bubble bursts or market sentiment changes. The volatility and lack of fundamental support in these investments make them particularly risky for individual investors who may not have the resources or expertise to navigate such turbulent markets. It is essential for investors to understand these risks and carefully evaluate their risk tolerance and investment goals before engaging in speculative investments. While the potential for high returns may be alluring, it is crucial to consider the downsides and the impact of significant losses on one's portfolio. A diversified investment approach that balances speculative investments with more stable, fundamentally sound assets can help mitigate some of the risks associated with speculative investments. By being aware of the risks and understanding the lack of underlying value and unpredictable nature of speculative investments, investors can make more informed decisions and take appropriate measures to protect their portfolios. Lessons from Warren Buffett. Warren Buffett's approach to investing offers valuable lessons that can help investors navigate the dangers of speculative investments. One key lesson is the importance of focusing on intrinsic value. Buffett emphasizes the need to assess the true value of an investment, considering factors such as the underlying asset, cash flows, and growth potential. By valuing investments based on their intrinsic worth rather than short-term market sentiment, investors can make more informed decisions and avoid the pitfalls of speculative bubbles. Thorough research is another crucial lesson that Buffett teaches. He advocates for investors to thoroughly analyze investment opportunities, considering factors such as the company's financial statements, management team, competitive position, and industry dynamics. The emphasis on research helps investors understand the fundamentals of the investment and make more informed judgments about its long-term potential. Furthermore, Warren Buffett's focus on the long term is a valuable lesson in the context of speculative investments. Buffett emphasizes the importance of having long-term mindsets and avoiding the temptations of quick profits. He believes that sustainable wealth creation comes from holding quality investments over the long term, allowing the power of compounding return to work in your favor. This patience and discipline helps investors avoid the pitfalls of short-term market fluctuations and the volatile nature of speculative investments. Buffett's aversion to speculative investments in favor of quality businesses with sustainable competitive advantages is another important lesson. He looks for companies that have durable competitive moats, such as strong brands, unique intellectual property, or significant economies by scale. By investing in businesses with these advantages, Buffett seeks to minimize risk and increase the likelihood of long-term success. Incorporating these lessons into one's investment approach can help safeguard against the dangers of speculative investments. By focusing on intrinsic value, conducting thorough research, adopting a long-term mindset, and seeking quality businesses, investors can build a more resilient portfolio that withstands market volatility and delivers sustainable returns over time. Mitigating risks and building a solid portfolio. Mitigating risks and building a well-diversified portfolio is crucial in safeguarding against the dangers of speculative investments. One strategy is to focus on asset allocation, which involves distributing investments across different asset classes, such as stocks, bonds, and real estate. This diversification helps spread risks and reduces the impact of any single investment on the overall portfolio. Additionally, diversifying across different sectors and industries further mitigates risks associated with specific sectors experiencing downturn and disruptions. Considering risk tolerance is also vital when building a solid portfolio. Investors should evaluate their risk tolerance, which refers to their ability to handle fluctuations in the value of their investments. It's essential to align investment decisions with one's risk to avoid being overly exposed to high-risk investments. Warren Buffett often emphasizes the importance of investing within one's circle of competence and comfort zone. Another key strategy is to prioritize long-term investment approaches. By focusing on the long term, investors can reduce the impact of short-term market volatility and benefit from the power of compounding returns. Warren Buffett's success is largely attributed to his long-term mindset and his ability to hold investments for extended periods, allowing time for quality companies to grow in value. Patiently weathering market cycles and avoiding knee-jerk reactions to short-term market fluctuations can lead to better investment outcomes. Investing in quality companies is another essential aspect of building a solid portfolio. Warren Buffett emphasizes the importance of investing in businesses with sustainable competitive advantages and strong management teams. Conducting thorough research, analyzing financial statements, and evaluating the competitive landscape can help identify companies with these qualities. Quality investments are more likely to withstand market turbulence and deliver long-term value to investors. Warren Buffett's warning about the dangers of speculative investments carries significant weight in the investment world. By carefully evaluating investment choices, considering risks, and prioritizing long-term investment approaches, investors can safeguard their portfolios against the potential pitfalls of speculation. Mitigating risk through all asset allocations and diversification, aligning investments with risk tolerance, and focusing on quality companies can help build a solid and resilient portfolio.